for coming back.
Pleased to be here.
Okay, so let's make this official. It is October 26th. This is the Edge live demo and discussion. I'm Tim Quast, joined by market strategist Brian Wilson. He laughs when I use that term because, I mean, he does everything. Welcome to this discussion. Only 2 rules: mute yourself while we talk, and please ask lots of questions. We don't have all the answers, but we will be very frank and forthright with you about what we do right and what we do wrong and what we've learned, and hopefully how to use these data effectively. They worked. I make mistakes. All of us do, but using these data and following them with discipline works. It does work. And I'm happy I can say that with conviction because we've got a lot of data under the belt and I've got a fair amount of time in the saddle using it. Okay, so we're gonna, we'll do about 35 minutes or so here. Brian Wilson is going to go first, so pay attention here. Then you can tune out during my section to wrap this up. So Brian, over to you.
Sure, thank you. Hey everyone, great to see you all again today. Thank you for any newcomers that might be with us today. I thought to begin, we might do a review. I did this about 6 weeks ago, but I won't take very much time with this particular look. But I want to share. So when we talk about 4 market behaviors in the market itself, this is what we're talking about. There's been a dramatic shift in the composition of the S&P 500. This is the world that I was used to when I was a buy-side trader. It's where active investors would move stock price. It just doesn't happen as much anymore. It still happens, but it's only about 10% of the time. What we have occurring over 50% of the time is computerized trading. Think of that as high frequency trading, day trading, that type of activity. Passive investment wasn't even really around in the late 90s, early 2000s. Think about index funds, ETFs, quant funds making up about 20% of daily trading. And then lastly, that risk management piece. We just came through options expirations. So think about calls and puts and swaps and futures. It's derivatives type trading activity itself. So a dramatic change in what happens every day in terms of daily trading. I'll show you one other slide as it relates to the 4 behaviors. And this is kind of getting into why each behavior does what they do. So active investors, think of that more as the fundamental piece. They care about things from a stock story perspective. Actually, think about CNBC, kind of the talking heads, they're always talking about fundamentals. So that's the active side, actually caring about the story itself. From a passive investment perspective, they're in play in the market because a given stock has characteristics that are similar to other stocks. Maybe it belongs in a certain sector or industry, its growth or value or its market cap. So that stock has a characteristics that the BlackRocks and Vanguards of the world care about. And that's why they are owning that, or that's why they're doing true ups during options expirations or coming up here on month end in a couple of days. That fast trading piece, they're just trying to profit on price differences. They're looking to, from a sentiment perspective, pick up 4s, buy 4s that are going to become 6s, or they're looking to short 6s that are going to become 4s. So they're looking to go both directions there. They don't know anything about the stock story. They could really care less. It's basically a blip on a screen, and can they make money off of that from a directional standpoint? And lastly, that risk management piece. Once again, that options part of things. Think about leveraging into positions or protecting positions, recognizing that all of those decisions have a cost associated with them. So I just wanted to do just a real quick review on the four behaviors themselves, because you'll see that on your screens. And sometimes I know there could be questions like, what do those terms actually mean? So just a quick review in terms of terms. This is an older slide. What I wanted to show you here, think about the fast trading side of the equation. We call this the Death Star. This is what it looks like when an order actually gets completed. This is a slide deck from T. Rowe Price going back to 2017. Tim might be able to update this for me. I did the best I could. I believe we're currently at 13 stock exchanges and 70 dark pools. But the point is, when you're entering an order, it flies around the market because it has to be between the best bid to buy and offer to sell. And whoever has that price then is going to get that fulfilled. That goes into all kinds of other ramifications that Tim has touched on before in terms of paying for order flow and getting paid to be on the bid and getting paid to be on the offer and all these different things that come into play. But you can see that there's incredible fragmentation, both from a geographic perspective and both from an order fragmentation itself, just in terms of what the algos are doing. So I just wanted to do a real quick review on those behaviors and what that looks like. Especially, I think about fast traders when I see this, because they are generally the closest to the order routers, and they're going to be the ones that are able to take advantage of this type of fragmentation. The next, and we'll stop here in a couple minutes if you guys have questions.
I might just interject really quickly, Brian. That the guy who created that slide is a guy named Met Kanak, he's the global head of electronic trading for T. Rowe Price, and he's I've been on panels with him a number of times, and he really understands market structure, and he used this slide to describe to the institutional customers of T. Rowe Price. He said, I want you to understand how difficult it is for me to buy and sell small caps, that every order has to, it starts, the two outside edges are the buyer and the seller, the B and the S on the outside there. That's kind of ironic. But so he said, it's going to have to go through an order routing, an order management, execution management system. We're going to send it to the market. And the last place we want those orders to reach is the stock exchange. Because by the time we get there, the market's probably already moved on us and we're going to overpay or we're not going to get a good price. But he said, this process changes the purpose of the market. That if you think of the market as an investment environment and it's got all of this complexity, the complexity becomes an end unto itself. And a great illustration of that, and then I'll shut up on this, is, I was trading notes yesterday with the head of IR for large industrials, and we were talking about this. And I said, in your stock, at any given moment, there are about 100 shares at the bid or offer, maybe 100 and 500 at the bid to buy and offer to sell collectively. But I said, if you go to buy SPXU, there are 250,000 shares of it at the bid or offer at any given time. So derivatives that you can trade for a half penny in mass completely dominate the market and displace investment in actual stocks. And a lot of that is this, because the price is constantly changing. And so if you have the ability to have your machines in all those locations like Citadel does, Citadel knows at all times exactly what the buy-sell balance is and which direction to go. So that I just want to add that to that image. It's public companies find that very interesting, this image.
Yeah, no, that's terrific, Tim. Thank you. And that's part of why fast traders have a little bit of an information advantage to what Tim just mentioned in terms of, let's say there's 50 limit orders out there in a given stock, and they know, what those limit orders look like, well, going all the way down the spectrum, but let's say just 50 cents down the spectrum. So they know directionally what direction that stock should go. So they're going to trade accordingly. and position themselves accordingly. Well, thank you for that add-on, Tim. I appreciate that. This morning in the note, market desk note, my opening line talked about momentum portfolio, that there were 2 names in our momentum portfolio, and this is an experimental portfolio, but 17 in my short portfolio. And Tim went through some dynamics last week, but if you're interested in setting up a short portfolio, I basically just took the opposite of the momentum portfolio. I won't spend a lot of time on this, but I just wanted to show you what it looks like. If you want to do something similar, you can add whatever other dynamics you want to look at. But market structure sentiment is basically pointing lower, dollars per trade, eliminating some of the small cap ones, trying to pick up a little bit of volatility. Market structure sentiment less than or equal to 4, short volumes greater than 50, 1-day trend up, and once again trying to pick up or not pick up those small caps, and then getting just greater volume. So I might have a little bit of redundancy in there just looking at it right now. I hadn't looked at the parameters for a little while. But just wanted to show you this portfolio just as an example. Like I said, you can do your own, but this is basically just taking the momentum portfolio and kind of just doing the opposite.
So you copied me.
Yeah.
That's cool.
That was the Norton rule. We've got the Hicks rule. Now that's the Norton rule. The Norton rule for shorting.
Yep, exactly. Quickly on the broad market setup right now. We've talked about how this is a market that supports being on the short side of the trade. What we see from a broad market perspective, once again, demand up top here. So broad market sentiment or demand has been slipping, and that's starting to pick up a little bit or intensify. Short volumes are starting to increase. So we're getting convergence instead of divergence. That's a market that favors shorting. If we look at this on a year-to-date basis, and we had talked about how this setup over the last 2 to 3 weeks really resembled March trading, and that's really played out. Here's what happened in March. We moved below the green line, which is oversold conditions. It basically took us about a month for us to pick up again. And we're kind of playing out that same way. We moved below the green line end of September, and you can see we're actually lower now about a month later going into the end of October. Now, what does it look like in terms of actually having this effect like we had actually moving forward again? I think we're going to need to get some short covering. You see what's happening with short volumes. It kind of gets back to that trend line, and then it's kind of rapidly moving higher again, and we're in a high short volume environment. You can see, generally speaking, how high we've been getting in terms of short volumes, about 51% early September. We had a high of, what was that, about 52% there in March. So these things change over time. If we had run this same graph about a year ago, these numbers probably honestly would have been 45 or 46%. The market has really shifted a lot during the last year, but you do have to pay attention to what's been happening recently. So right now, when we get up to that 51, 52% level, that's been a cue to start covering shorts. We'll have to see how this one plays out. But right now, that's the setup. Continues to favor bearish positioning. I did share with you earlier today kind of the number of names right now that are bottoming. This is where I got this information from. This represents our collective companies. I think it's a little over 3,100 right now. And what is happening is the number of companies that are down continue to dominate. That's been the case here for the last 4 trading days. What's starting to happen, though, is that the number of companies that are bottoming is starting to increase. I mean, that's good, but you can also bottom at a 1. What we'll need to watch is for those number of companies that actually start moving higher again. And as you can see, we're not there right now. This was an environment where we actually, I think we had one day that we had like a 1% gain in the broad market. But this is not a very supportive of environment for appreciation yet. That might change, but that's where we're at right now, starting to get more companies that are actually bottoming, but most of them are still pointed lower. One other area I wanted to cover with you guys, and I briefly spoke into this concept this morning. I'll tell you why I spoke into it. I was talking about the financials and how there was actually some short covering yesterday. So financials as a whole, and we see, demand is slipping. It's down below 5. Short volumes went down yesterday. I believe that was 110 basis points, if I remember correctly. So short volumes moving lower. What really intrigued me, though, and I didn't want to share this this snip because you didn't have access to it, but this is the 7 largest financials by market cap, and I was intrigued by the fact that short volumes are now down to about 39% for them. So shorts are really starting to get covered for the big guys, and a lot of times the big guys are kind of the first movers, and then everyone else will move afterwards. What we're not seeing yet, though, is we're not seeing that increase yet in demand or even a stabilization in demand. So it's improving, but we're not quite there at this particular time. I'll take it one step further. And so that's the look at the financials. If we look at big tech, we would see a similar setup. We see demand still moving lower, and we see a little bit of a stabilization for short volumes, but short volumes there are not moving lower yet. So that's the setup for some of the big players in the market right now. And with that, I will go ahead and stop sharing and turn it back to Tim.
Okay, thank you very much, Brian. Let's see here. I'm going to share my screen, and I'll just follow up and say that if you want to find those, those 7 largest financials, you can just do that pretty simply this way. Just go into the financials. I'm telling you something you already know, but you could go into the financials sector and just sort by market cap, right? So there you go. I don't know if you're using Berkshire Hathaway, probably not, but it's pretty easy to find these that way, just by sorting using market cap.
And for today's 3-stock lunch, first up is UPS.
So let's see here. I've got 2 things to cover. This won't take long. One is I mentioned in a market desk note how you can see when big exchange traded funds, just say BlackRock, Vanguard, State Street, are coming and going by looking at the data here on your dashboard. And an easy way to do that is to look at the big tech portfolio. You could create your own proxy for this. This is on your dashboard automatically. We create it for you, and we include some other things besides the so-called Magnificent Seven. But you could it follows this cadence and calendar that we talk about. New months can be new money. The middle of the month, and I'll tell you exactly what I'm pointing at here. And the middle of the month, roughly, is when options expire and money may change directions. That's why then. Well, there's better liquidity associated with options and futures expirations. There's a lot of liquidity behind the scenes associated with that. I will see it sometimes in where my trades execute. I had a trade execute at the Miami Stock Exchange, which is very unusual, and a pretty large one in a leveraged short ETF, and that's probably associated with options or futures on those instruments, and the liquidity is there. But this is how you can look and know that these things are happening. Big tech will, until something significant changes in the rules of the marketplace and where the market cap resides, they're going to be the leading indicator. And so I think it was on October 2nd when in a market desk, not because I'm smart, I just look at the data. I could look at the data and say, well, tech stopped falling, and look at the supply deficiency. The supply short volume had come way down into the beginning of October, and demand bottomed. Well, in AMD in particular, AMD is a great, it jumps from 1 to 10, but it's following this wave of tech. And there are other things in the semiconductor group that kind of behave similarly. And you could look at that and say, well, probably the mathematical probability is that those things rise and that there will be a run probably roughly into options expirations, because there is so much market cap, 20% of it, that depends on those. And if they're rising into options expirations, it's going to squeeze people who are going to have to cover, right? They're probably going to get called, right? They're going to have to supply equity. And then all of those big institutions are probably going to be overweight. And now why wouldn't they wait for several months? Because everybody's kind of antsy about US equities. And so then we could say, that as big tech began to turn over and supply began to rise, well, what would probably happen out the other side of options expirations? And this is the point number 2. So point number 1 is that will tell you could look at that and have a pretty good idea what the largest holders of big tech are going to do. And if they get rid of it, the market begins to decline, and it has an accelerating effect, because then ETF shares have to come out of the market because they're tracking the underlying assets. So Morgan Stanley, firms like that, authorized participants will go get baskets of buy up ETF shares and provide them to BlackRock, and they will receive in exchange a basket of stocks, which they will short and dump. It's how the market works, and we can see it coming. It's not perfect, but it's a pretty good indication. And the offset will probably be consumer staples. And it's not because consumer staples will rise, but they can be half the volatility. And so BlackRock, Vanguard, and State Street, which have to track and index the same stuff that those big tech stocks are in, they'll just shift to consumer staples. And so consumer staples will show rising demand, maybe a surge on the supply side, because they just want it to have no volatility. And so we can see that. Not perfect, but it's a pretty good way to think about the market, which leads into point number 2. I mentioned these things, again, not to pat ourselves on the back, but as a reminder that the data are pretty effective. We could tell you, okay, you can go long the market and probably long big tech. Then we could tell you, probably not a good time to do that. Now it's time to think about shorting the market. On Market Structure Monday, I said I will be surprised if any of the big tech stocks perform well with results. Now, Microsoft did fine yesterday, but it's given it all back. All the big tech stocks are suffering, not because of their numbers, but because of this. And it's such an important lesson on the market. Fundamentals do not drive the market consistently because, as Brian noted, they're 10% of volume. 90% of the volume is some other purpose or time horizon that is shorter. And so you have to know when those things wax and wane. And if you follow that, it works pretty well. Again, I'm not congratulating myself here. This is what, I've said to my wife, if you gave me $5 million instead of 50 to trade, then I'd have made 270,000 this month instead of 2,600 or 2,700. What I like about what I have learned through, how do you learn to exercise good judgment? By exercising bad judgment. I have made mistakes. If I back this up to a year, I've had a very nice, I've had a good year reasonably, 16%, but I'd have been up 50% if not for this mistake and this mistake. Well, I don't intend to duplicate those, where I held something around earnings that I shouldn't without any, there's no protection. Well, don't do that. What I have figured out now is just be very careful about taking your gains. And a lot of this has I've been doing, not that I'm advocating it, but I certainly have found that it works, is particularly when I shift short, I trade SPXU. Look how much I've traded this. It goes on and on. That's it. And here's the Pearl. That's the Miami Stock Exchange right there. So I'm very careful. If I know that the central tendencies are all pulling in one direction, then I will make sure that I'm not going to be exposed to any particular loss, but I take the gain and I repeat and I take the gain. And SPXU is a leveraged short S&P 500 ETF. It's a derivative of a derivative. Do I think those are great instruments? No, I think it's a travesty that the SEC has permitted these instruments to trade. But because they take capital away from long-term capital formation, which the market is supposed to be about. Well, okay, they've approved them. The exchanges want them. BlackRock, Vanguard, State Street, Invesco, ProShares, Direction, they all want these things. Traders want them. Okay, well, so they exist. So I make use of them. On the short side, it's a very efficient vehicle because it trades with a half-penny spread. You can buy thousands of shares at a time. You can put in stops and limits. If I get the timing wrong, I could get stopped out and I lose $50. Okay, well, I got that. I was a little overeager. If the S&P 500 if the market's trending down and it pulls back 50% of that, we're probably going to short that till it goes down 1%. Cover, repeat, because the market will move roughly in this range unless there's a sort of tail risk event, which could happen. I'll talk about that to finish. But generally, it's going to trade in predictable volatility ranges. We talk about volatility all the time. One of the core things we look at, something's down, half its volatility. What's the probability if the market is moving a particular direction that you can make money? Very high. Why? Because everything has to be between the bid and the offer. That's the average. All the funds have to have less than 2% tracking errors. 90% of trades in the market are derivations of midpoint. You put all that stuff together and volatility becomes a very good way to take gains. And that's how you make money. Look, I think it's a great market? No, but this is how it works. And if we use it to our advantage, then we can be very profitable, safe, successful, unstressed traders. And so that's, I think it's important to know. I repeat these things because we told you, right? We're not telling you because, again, we're smart, but because the data are very effective. They reflect these underlying rules. So here, the last thing that I will mention is this tail risk thing. I don't know what's going to happen. I'm going to return to what Brian covered here. And, you can look at the rising supply and falling demand and say, well, that's probably not going to be good for the market, particularly coming out of options expirations. Here, to me, is the potential for tail risk, a decline of significant magnitude. So I don't know anything about patterns in these data. I don't know if they have any merit whatsoever, but I'm going to point them out. See this back here? So there was big covering and the market, and then everybody shorted and the market declined. There was big covering and the market went way up, and then everybody shorted and the market declined. And we've had that here, but at a much higher level, right? So this is the same event as this and this, but it's happening up here above, basically above 50%. So what happens if it goes up? Well, we could really fall off the cliff. I'm not saying that's going to happen. I hope it doesn't. We all have long-term accounts. I don't want the market to fall apart, but I look at that and say, there is tail risk there. If what happened here and here happens here, the market is going to decline significantly. And it's already declined significantly. I don't know what's going to happen, but it makes me continue to be very cautious. I'm happy to sit in cash. I don't have a position today because I just didn't see a good opportunity. Actually, the Dow's only down 21 points. Could be that at the end of the market, I could put on a short again, because I don't think the market's fit. It won't be linear. But right now, if you look at the data, would you expect the market to suddenly surge? Well, it can happen. It can happen. But it's very unlikely mathematically if you look at these data. Surging supply, falling demand coming out of options expirations. So questions, comments, thoughts, observations. I'd like to hear what you guys think. I'll stop sharing.
Hey, Tim, I think we saw a textbook move in the market when you talk about options expiration. You had 3 down days during expiration. Monday, Tuesday, new options, counterparty Tuesday, market up. We hit Wednesday and boom, you see the market.
Agreed.
I've never seen a more perfect example of expiration the following 2 days and then Wednesday.
I agree. I was very confident. I put on a very significant short when the Dow was up 260 points on what counterparty Tuesday. Right? I thought the odds are really in our favor, right? And it was my second best trading day of the year because of that. Yeah, it was a good time to do it. James, please.
This one's for you and for Brian.
Okay.
I would say that in 2023, the momentum trade worked apart from the banking crisis in March up until midsummer.
Mm-hmm.
And then opportunities and momentum have been scarce.
Yes, they have. Yep.
But with momentum, there's outsized gains on individual stocks you can get over and above the SPY or the NASDAQ, which means you can have more losers. If you're trading 20 trades, you can have 10 losers, you let 7 run, and you break even on 3. You know, I'm just talking hypothetically. No, that's exactly roughly how I used to do it. And you wait for the pullback as well, 50% pullback on those momentum trades.
Yep.
That worked very well for me, and was fantastic, based solely on the data. You know, there was no, so that was great. Since then, I've struggled because I'm looking for this inverse momentum or supply and demand divergence, which I think Brian's working on that now. And is that a pilot, or is that going to be part of the dashboard going forward? Because I'm not making outsized gains in shorting the SPY, because I haven't got different components that can outsize me. Does that make sense? So I'm gambling more on individual trade on an index, rather than having the buffer on momentum, where sometimes I could have 7 or 10 components. So what I'm looking for, and maybe it's not available yet, or I know there were some parameters that Brian put up tonight, are we looking at something like that, and have we pilot tested it? Are we going to run it on the dashboard going forward, the inverse one?
Brian, you want to take a stab?
Sure. It's very new data. It's very new data, James, in terms of looking at that. I looked back over a 3-month period, and that inverse relationship, as I tested it, worked 4 out of 5 times. Now, that was only as I said, that was only on a 3-month basis, and that's as far back as I've tested it so far. And I don't know if it was working earlier in the year or not. So
the nuances that I've found is that a key parameter is that I find it works best when you're coming off 9 or 10 on the way down. That typically seems to have the best returns when you're trying to short something, when you're doing the inverse of what you're doing, Brian, which is opposite the momentum portfolio.
Thank you, Barry.
Let's see. I would add that one of the things, James, that and Barry, it comes from I think you suggested this. Could there be maybe it was you, Dan? I can't remember. One of you all suggested this to me. Maybe it was a couple of you. Could we do a correlation score? What I would love to have on the screen is you look a stock up, and first of all, it tells you whether you should try to trade that or not, and then whether that stock has a what the correlation score is. What is the probability, given the current supply-demand divergence, that in the next 3 days you can produce a reliable return? And I'm working with, I've got an engineer, and I've got Nate. You know, I call him young Nate the mathematician. You know, he's our head of database systems, and he's a math guy. So I had this discussion with him yesterday. I said, this is what we have to figure out. And part of it is we're integrating some content with interactive brokers. We're going to have some iframe content. I think we're not only the second content partner that they're doing this with. And so I want to make it so simple for people to be able to go, I can understand this data and I trade. Because from a business perspective, what matters to interactive brokers is, can this information drive a transaction for us? And from our perspective, if we can make it so simple that you can say, oh, that is a high probability, and it produces an action, then it's beneficial for you all and for me, right? I mean, I'm using it too. I am serious. I'm trying to get, I said to Karen, I should be trading $5 million, not 50,000, because I've kind of got it figured out now. I feel very confident with this data, but we need that piece of the puzzle. And so we don't have it yet, James, but we're sure working on it. And we will get there. We're going to get there to where we have something that I feel confident that we can give you. I don't want to give you something that we haven't thoroughly vetted and tested, you know.
Sure.
Mhm.
Yeah.
Thank you.
Yeah, absolutely.
And just one add on to what Tim has mentioned. He continues to test our long-term portfolio. If you're familiar with that, we've talked about that a couple of times, and boy, the returns continue to be outstanding. But it's also one of those things that we need to make sure to vet it and make sure they're accurate. But those returns are off the chart.
They are really good. But I found we were over compounding cash. I went and ran through the data and I went, wait a minute, there's an issue with it. It's the cash account. It's not the positions. So, but they are good data. They really are good data. And it's very encouraging for me to run that data and just let it run, and we are consistently producing returns following a particular approach. The biggest challenge, the same challenge that the big institutions have, the number of stocks that will produce those returns is frighteningly small. We can run a model that looks at 3,000 stocks and it comes back with 4, and it tells us to sit in cash. We can't find 5. We're sitting in cash. And that happened this week. It came back and said, there's not enough to be long the market. And isn't that something? I know that BlackRock is running into the same problem. There's not enough stuff that produces a return. This is not Jeff Vinnick's, Fidelity Magellan market where you could just go find this undiscovered small cap that will go up, that will be a 10 bagger. That market does not exist anymore. So it really does take the math to make it work. Okay, we went a little bit long. Apologies. I did. So, but thank you. We'll keep working. I'm very confident with this data. We just need to keep making it simpler to use and understand, and we know that. So we'll keep at it. All right. Good to see you all.
We need an export.
Winter's coming here. I'm headed to Aspen over the weekend, and I think the snow and I will arrive at the very same time. Alas. Enjoy your weekend. See you guys.